thank you for attending our webinar on capital allowances. Some housekeeping before I introduce Michael Brownston. You will have heard the recorded message saying that this is being recorded. We like these events to be interactive, and so if you do have any questions, please put them in the question and answer tab that is part of the Zoom link. And with that, I will now introduce Michael formally. Michael Brownston is both a chartered tax surveyor and a fellow of the Association of Tax Technicians. I first met Michael, I would say, somewhere between 12 and 15 years ago, when he was at Savills. He was recruited into Savills to build up their capital allowance services, and then that was so successful. He was then taken over to Knight Frank, and he was a partner at Knight Frank, leading up their capital allowance service stream before doing the brave decision of setting up his own consultancy, obviously primarily capital allowances, in 2019. And the capital allowance side of his business, obviously, it provides advice to investors and occupiers of all sizes, from simple office fit outs to there's a job that Michael and I have worked on that was almost £500 million for a hotel that you will have definitely heard of. I know we're talking about capital allowances, but I can't introduce Michael without also just letting the audience know he has a stamp duty side to the business that is quite interesting, looking at purchase consideration and the extent to which it is stampable or not. But that's not the main topic of today. The main topic is capital allowances, and this is quite an in-depth review of allowances, because looking at the audience, we've got some people who have some serious knowledge and big numbers floating around. But just for the benefit of those who don't necessarily come across capital allowances every day, can you just start off, Michael, by just giving us that high level summary as to what they are, what they're intended to do, and how they function, primarily for our property orientated attendees?
Certainly. Thank you for that introduction, Graeme. I can't believe it's been that long since we started working together. It seems to have flown by, but been lots of fun projects that we've been doing together. But to start off, yeah, capital allowances. Like you say, a lot of people are very familiar with what capital allowances are. However, I do come across some people, particularly on the property side of businesses who are doing deals, who may not be too familiar with exactly how they work. So I'll just cover off what they are and how they work. So capital allowances are a tax relief that are used in place of depreciation. So they're used for the writing down, getting tax relief on assets that have sat on your balance sheet and therefore have been used over, have a useful life over many years. And they apply to all sorts of things that are used in businesses, but within this webinar, we're looking at those allowances that are particularly relevant within commercial properties. And there are two main types of capital allowances that apply. The first group is plant and machinery allowances, and the second group are structures and building allowances. The plant and machinery allowances, these are the types of allowances that most people think of when capital allowances are discussed. They've been around for many, many years, and are further subdivided into two main groupings. The first one being special rate allowances, and this is a prescribed list of items within the integral features, and also wider assets which have either long lives or some particular special uses. And then everything else falls within to the general or the main pool of allowances. Separately, the newer type of allowances, I say newer, they were actually introduced back in 2018, are structures and buildings allowances. And rather confusingly, they don't follow exactly the same rules as plant and machinery allowances, and are used in different ways, which is rather frustrating. So plant and machinery allowances are added into pools, which are then written down at a fixed rate each year. So the main pool is written down 18% per annum, and the special rate pool is at 6% per annum. Plant and machinery allowances have a reasonable amount of flexibility with them. There are some accelerations available, so they can be used more quickly, and they can also be disclaimed and saved up for later periods. Structures and buildings allowances don't have that ability. They are written down as a fixed 3% per annum. There's no, or very limited acceleration, and they operate on a use it or lose it basis. So if they are not claimed in a particular period, they don't roll forward into future periods. They are just lost. And the trigger point for claiming the allowances are triggered at different points as well, but we'll come to that a bit later on.
Thanks, Michael. And you've obviously identified that there are different assets out there, and the rules are slightly different. So, what type of property costs would typically qualify for allowances? And probably more importantly for the audience, what are the things that you find get missed most frequently?
Okay, well, nowadays, since the introduction of structures and building allowances, most expenditure will probably qualify for some sort of relief. It does depend on the property type. But even though most things will qualify for some sort of relief, the rate at which that relief can be obtained does vary quite dramatically, from having full expensing, so having all of the writing down allowances available in the first year, versus having something written down at a fixed rate over 30 odd years. And most people are aware of the things that can typically qualify in buildings, so things like the lighting and the heating and air conditioning and the lifts and the sanctuary and all those sort of things. Those bits and pieces haven't changed. Relief is available on those items now, as they have always been. Where things get missed and overlooked, if we're looking at building projects, which is where you're spending new capex developing something, we see a lot of pre-commencement expenditure is often overlooked. This is typically professional fees, but they can be incurred in tax years before the main construction starts, and they would often get overlooked as people concentrate on just looking at the main construction expenditure. Similarly, where there are any demolition or decommissioning costs incurred, again, these are typically right at the start of the project, typically involve a different contractor. Those types of expenditure will not necessarily be looked at in detail, even though plant and machinery allowances are available on stripping out or decommissioning plant. On larger construction projects, we see a lot of direct spend is overlooked, and people tend to focus on the main contractor and the expenditure undertaken by them, but will often overlook either specialist contractors for particular packages, or again, additional professional fees in certain areas which are not contained within the main contract spend. And then on smaller projects, what we find gets overlooked are undocumented spend. So either lump sums that are paid to builders with no breakdown, or where there is a mixture of services provided by one provider, and having no detail provided with that. On the buying side of things, where second-hand properties are purchased, or even new properties, we often see that this process is often misunderstood. A lot of people think that a Section 198 election, which fixes the transfer value of plant and machinery allowances, is the end point within a transaction. For us, we find that's the starting point, and there's typically quite a lot of things which may fall outside of an election, and it's important to keep on asking questions even when an election is present. It's important to understand the building's history, because there may be who's done what to it at what time, who the prior owners have been, any pension or charity ownership in the history, who developed it and when, etc. And so we often find there are unrestricted items which fall outside of Section 198 elections.
And that's really interesting, because I think if you ask the average businessman in the street, of course, they assume that the capital allowances are actually for the construction and the purchase of the building, but there's a whole load of stuff that might happen before that that is eligible, and I guess that's a sort of takeaway from that session. And so just sticking to, the opportunities, based on your experience, what are some of the biggest mistakes you see business make in the capital allowance field?
Well, the biggest mistake, because of this unusual thing which sits within property but within tax, there's often an assumption that somebody else is covering this, and so it's not unusual for people who are dealing with doing the property deals that it's going to get picked up by the tax team later. The tax team may think that their external advisors are picking up on this. The external advisors may think the tax team have looked at this already and discounted it. And so there is this, we often find this assumption that somebody else is picking up the detail and has covered off and has asked the questions. So we often hear that the answer, there are no allowances. And that's not the same as there are no allowances available. It's there's no allowances have been considered or have been offered. And so that assumption that somebody else is picking up this point in detail and has looked and has asked all the relevant questions at the relevant time is the biggest I wouldn't say mistake. It's the biggest area of oversight that we have seen. The second most common mistake we see is on timing, and it's almost related to that first point, is leaving it too late and trying to pick it up after the fact, and trying to look at things after either the bulk of the work have been done or the transactions completed. If you can get in early with the right questions, you can much more easily change the outcome of the amount of allowances that are available. If you leave it too late, it becomes much more difficult either getting hold of the relevant information or in changing the behavior of a party that you're interacting with. And thirdly, it's believing that there's no value in the allowances and just thinking that there's nothing there. And that's where it comes back to having a look in detail and asking the questions and seeing whether there is some additional value in that expenditure that you're incurring.
I think based on your opening comments about the types of allowances, if anyone says there's no value, I think they need their head examined. We've had a question come in, and I'll sort of paraphrase it because I can see where it's coming from, and that is, if it's picking up on your point about the possibility of leaving it too late and just managing a process. So I guess if you think of 4 parties to a transaction on maybe the buy side, you might have the property agent, you might have the tax advisor, you might have the principal client, and you might have the lawyers. And it sounds like someone needs to control this and manage the capital allowance aspect of the transaction. Out of those 4, so that's agent, principal client, tax advisors, lawyers, which would you sort of expect to drive the capital allowance side primarily?
So out of those 4, it would be the tax advisor that I would look to, because they should have a broader appreciation of all the taxes that are in play. So agents tend to be just focused on getting the deal done because that's where they get their commission. And having been at Knight Frank and at Savills, I'm very aware of just how focused agents are at getting deals done, because that's their primary role, and rightly so, because that's what ultimately drives the value, is getting the deals done. Now, lawyers, I find, tend to be conservative and are more chasing the paperwork. So is there a contract? Is there an election? Doesn't matter what it says in the election, just it is the one. And the client may not be aware of the additional tax relief available. So I would typically look to the tax advisors, and secondarily it would be raising awareness within the client so that they ask the relevant team. But certainly for agents and for lawyers, it just tends to not be on their radar to seek this type of additional value.
Thanks, Michael. That's sort of what I was expecting you to say, but never prejudge what a professional might conclude.
You go pin it on you, because you're acting as tax advisor. It's your fault, Graeme.
Just let's stick to that principle of a transaction. When should capital allowances be considered in the timeline of either a transaction or, or an ongoing project?
So we'll stick with transaction. So earlier, well, for both, is earlier the better. So for the purchase, we advise our clients to make sure that there is some wording relating to capital allowances within the original offer. So right at the start, you have a discussion. You found a building that you want to purchase, and that offer that you make to the seller includes the phrase that the allowances will be transferred to the buyer on completion, and also that cooperation will be provided in order to that to happen. And once that goes in right at the start, makes everything downstream much easier. So get it in the offer, make sure it's there when the heads of terms gets drafted, and once it's in the heads of terms, then when the contracts eventually get put together, you can always reference back to say that this is required because that's what was agreed at the start of the transaction. So ideally, right at the start of the transaction. The second best time is then before contracts are signed, because once the contracts are signed, the transaction is effectively solidified, and you're unlikely to get the seller to cooperate further. You may do, but it'll be down to goodwill at that point rather than a contractual obligation. So the sooner the better. Heads of terms ideally, but secondarily certainly in the contract. And again, on the capex side of things, there's slightly more forgiving on the capex side of things. You don't necessarily get quite the same hard stop that you would get with a transaction. But again, if you get it consideration in early, you may be able to work out your cash flows better with the allowance for the tax deductions. I would certainly like to see a clause within any contract stating cooperation from the contractors to provide the relevant information for capital allowances purposes. Again, it's generally easier to get information out of builders whilst money is outstanding. Once builders are paid up, especially at end of projects where relationships may have soured, they may be less inclined to share that type of information with their clients. So again, nice and early, get it in writing where possible, and it'll help downstream to try and claim the right amount of allowances. Because typically, because tax is always done retrospectively, we often see where we're trying to put something together for tax returns and the project's been complete by 12 months ago, and it's more challenging. It's not impossible, but it's more challenging. So if you can get this done earlier, it's good.
And I'll ask a question I definitely know the answer but I'll actually just for the benefit of the audience, because quite often you and I interact across balance sheet dates. You have a contract, maybe a build that will take a couple of years, or a fit out that will take a couple of years because they're doing a few rooms or a few floors at a time or whatever. What's your views on regular balance sheet surveys?
So yes, it's important that all the capital allowances claims are tied into the financial statements. They need to be reconciled into the balance sheet as what's been capitalized, and so doing that on an annual basis is a minimum. So that's where possible, inspecting properties if they're mid-project, but certainly reviewing the construction cost information at year end and providing that within the financial statements is really important. So it's almost a two-stage point. One is seeing the property at that year end, and then reviewing the data once that is available. So normally the construction information is available reasonably soon after that, because there'll be stage payments and stage valuations, which generally come out reasonably regularly, and then that'll be tied into the financial statements, which are then available anywhere between 1 and 6 months later, depending on the nature of the client and the nature of the advisors putting those statements together. But yeah, certainly for multi-year projects, reconciling into each tax period is very important.
Thanks. And because there are some occupiers in the audience, are there any specific issues that you would flag for them?
So there are two things that spring to mind for occupiers. I kind of both related. Is who's paying for the work. So the first one, are you as the occupier paying for the work, or have you received a lump sum from your landlord for contribution towards that fit out? Sometimes incentives are given by your landlord to try and incentivize you to take a space. It may be a rent-free period, or it may be a contribution to certain items. If there is a contribution, how is that documented? Is it a lump sum for everything? Is it allocated to specific items? It's not unusual for landlords to specifically allocate it to carpets and floor boxes, for example, because they're things which often get left behind by tenants, but their contributions may be far more wide-ranging, and it's important to know whether that is allocated towards something, and so consideration can be taken, or whether it's a generic incentive which can be spent on anything. And then it comes down to what part of the negotiation has meant who gets the principal benefit from those allowances. As I mentioned earlier, different allowances get written down at different rates. Some can be accelerated, some can't. So some allowances are more attractive than others. So has the allocation of those allowances been allowed for in an agreement for lease? So if you've not got to that stage and you're looking to fit out space, you are receiving a contribution. It is possible to negotiate that those are in the occupier's benefits rather than the landlord's benefit. The landlord, for example, may be a pension fund, may have no requirement for the allowances because they can't claim them, in which case, and draft the agreement for lease so that the occupier gets the principal benefit. And secondly, if you've got as an occupier, if you've got a complex corporate structure, you need to pay attention to who's using the space and who's paying for the space. In order to claim capital allowances on fixtures, you need to have an interest in land, such as a lease or an agreement for lease, or even a license or an easement, but you need to have that interest in land. And I've seen it where one occupier, one entity is taking the space, is on the lease, and then another corporate entity somewhere else within the corporate structure is deemed to be the party to be paying for all of the fitting out, and all the contracts for the fitting out works are within this other company's name, and they wouldn't be able to claim the allowances because they have no interest in the land or where those fixtures are going to end up. So it's important to make sure that to consider who's paying for the actual works when taking on space. And then secondly, getting information. A lot of office spaces are fitted out on a design and build basis. So specifications are agreed and a total price is agreed for providing space in that specification. There's not necessarily any breakdown of what goes into that fitting out. Again, if you can get a clause within that contract to provide that information for capital allowances purposes, that's going to be very helpful. Otherwise, you potentially could end up with just a lump sum and then having to do the work of splitting it out.
If we turned it on its head, and rather than looking at the occupier's perspective, let's look at that from the landlord or the investor's perspective. What would be the key messages that they would be bringing to the negotiation table?
It's almost that first point is just flipped around straight away. Is if you're giving some money to incentivize someone to take some space, make sure that you've written into the agreement that you get the first pick of those allowances if you're handing that cash over. There's a section within legislation that allows you to divvy that up in the whichever way you see fit. But again, it's getting that and documented within the agreement for lease is typically where that goes. For investors, there are also wider considerations to be had, not just on the eventual occupation at the end of the process, but earlier on in the process, looking at building and developing the building in the first instance. Some overlap with the occupiers. Again, who's paying for it? Is it the same entity that owns that property? The information that we see on large projects does tend to be better because the nature of the larger spend tends to lead to better breakdowns. But we have seen large engineering-led projects, which are still focused on the performance of the contract rather than the actual spend. So again, if you have a project of that nature, which is triggered on meeting certain milestones, and we've seen also in warehousing and distribution type properties where payments are made when the frame is up or the roof is on, or the watertightness is made, rather than on certain levels of spend. Again, ensuring that you're collating data throughout the project and getting additional cost information for capital allowance purposes beyond just those for triggering certain stages within the projects. Again, as I mentioned earlier, looking at direct costs, a lot of focus is given to the main contractor, but certainly for sizable construction projects, there will be significant direct costs, whether that be for fees or for specialist contractors. Again, collating the information, figuring out what it is that those specialist contractors have done, and assessing them separately. It's not always the case that you can apply a blanket percentage of qualifying allowances for those additional professional fees. It may be relevant in some cases, but in others, you need to look at the underlying service provided by those professionals. You also need to be aware that the different allowances kick in at different times as well. So the plant machine allowances kick in when the money is spent and the qualifying activity has started. So again, be aware in SPVs that there may be a delay to starting to claim the allowances if the qualifying activity hasn't started. But for structures and building allowances, the allowances kick in when the building is first used. And so the writing down those allowances can often start at different times. When you're refurbishing or repairing a building, so you've got an existing building which you're doing extensive works to, pay attention or have consideration towards whether any element of those works can be written to the profit and loss. Can any of them be treated as a repair? Is it beneficial to do that or not? It always used to be the case that we would advise clients to look to claim repairs where they could, because otherwise there'd be no other tax relief. But now that structures and buildings allowances are around, there has to be wider consideration to give into, do we try and take a relief via the P&L account, or do we look to capitalize it in order to affect any gains position at a later date? And then separately for the buying process, I think we've covered off some of these bits and pieces. Is what's in the offer, what's come back in the CPSE replies, what's the history of the building, who's done what to the building, when have they done it? Now, has there been any discussions? Is there anything in the contract? There's this perception that apportionments, just a reasonable apportionments on second-hand properties are no longer a thing since the introduction of the fixtures rules about a decade ago, just over a decade ago. But it's not the case. That there's still some value to be had in looking and finding allowances on transactions, even where an election may be in place, or even where there's an uncooperative seller as well. There still may be opportunity and scope for identifying additional allowances.
I've had a question come in that's relevant for investors, but it's a very specific question. So what I'll do is, while I think about how to phrase it in a more generic way for the audience, you've talked about occupiers, you've talked about investors. Of course, the other part of the property world is the developer. What's the developer in for in terms of the capital allowance space?
Sure. I mean, historically, developers, it's a nothing for developers. And by developers, I'm specifically talking about entities that hold their property as trading stock. So not necessarily people who are building it to hold, but developers are holding it as trading stock. It used to be a nothing because they build it, sell it on. They can't claim because capital allowances, the building needs to be held as capital on capital account rather than as trading stock. Now it's slightly different for two reasons. One is the introduction of structures and building allowances. And as I've mentioned, they're triggered. The start of the claiming period for structures of building allowances is different than it is for plant and machinery allowances. And if a developer lets a building, and so therefore it is used before selling it, that's triggered the start of the SBA period. And so they will be expected to hand over the construction cost information to the buyer so that they then can claim SBAs in the future. So this is contained in an allowances statement, which sets out the total amount of construction or qualifying construction expenditure, which then can be passed on to the buyer. And so there is some relevance and some requirement to capture construction cost information and provide these to the buyer, whereas historically it wouldn't have been relevant. And interestingly, where a purchaser is buying from a developer, in that instance, they would do an apportionment on the plant and machinery, but would take the structures of building allowances at construction cost level from the seller. If the building is unused, then it's an apportionment for everything, but it's that used or not used bit, which is different for SBAs than it is for plant and machinery allowances. And the other case where it may be relevant is we do see quite often where developers retain a rump of a development, whether that be a mixed use scheme with resi above and commercial on the lower areas, or trading parks where most of the units are sold off, but a small part is retained. Wider allowances may be available for that retained part, which is often transferred intra-company to a holding company. But again, be able to crystallize all those allowances on the wider expenditure and use it to offset the income from that retained part can be useful. So it's not just necessarily a forget about it, that there may be some benefit to do some analysis. Oh, sorry, and as one of the things on developers, land remediation may be relevant to them as well. Now it's not a capital allowance, so we're not going to cover it in detail here, but there is it can be quite a generous tax relief or even a payable tax credit for corporate developers where they've had to remove certain contaminants from the site before developing.
Thanks. So really the question that came through was a party's in the middle of buying an office building, and the heads of terms say that they confirm that the seller will be helpful and the buyer can claim relevant allowances. But the CPSE says that allowances have never been claimed. So you have this dichotomy. The heads of terms say, we'll be helpful as a seller and you can claim your allowances, but maybe there's nothing out there to claim because we haven't claimed anything. So what would be your advice in that scenario?
So agree to transfer them across, but when they've gone and looked to see what they've claimed, turns out they haven't claimed anything. Okay. So what we'd advise in this case is we would seek to get what's known as a pooling clause added into the contract. So this is a clause that would require the seller to pool allowances identified by the buyer into their tax comps in order to comply with the relevant pooling legislation, and then transfer that across to the buyer. So again, I've made the assumption that the seller is a taxpayer, and therefore could have made a claim to capital allowances. And the way the legislation is set up is that if they could have made a claim, they need to make a claim in order to pass anything on. And so we would look to get that clause in the contract so that the detailed work could be done after the contract, so it doesn't necessarily hold up the transactions. The transaction can still complete. And then we would look at the seller's position from when they either acquire the property or they have done works to the property and work out whether they could have benefited from any capital allowances during their period of ownership. Pool all of those allowances in one period at the end of their ownership, especially zipping it into their tax comps and taking it out by an election and then passing them across to the buyer. So if you've got a seller who's willing to cooperate but hasn't done anything either because they didn't need to because they had they didn't have taxable profits for whatever reason, then there is still an opportunity to go back and work it out as if you were the seller before passing them across to the buyer. It may be the case that they haven't claimed because they were a non-taxpayer, in which case you'd look through and look back at whether anything came from their earlier transaction, whether there was an earlier election or not.
Thank you for that. If we change tack a little bit, as a tax professional but not a capital allowance expert, I'm amazed at the number of tax cases that seem to pop up in the professional press, in the capital allowance world, and the legislative changes that seem to change quite regularly. And I guess, special rate stuff is a good example. So, just for the audience, in recent times, what are the key messages that might be out there in terms of changes?
Yes, it's always that thing. We think it's settled, and I think there's nothing going to happen. And obviously, change of governments come along, and they're trying to incentivize people to spend money in the economy and drive productivity. So they have a little tinker with the capital allowances relief in order to try and incentivize that expenditure. And recently, it was the super deduction. This is going back a few years now, and that was brought in ahead of the changes in the corporation tax rate. But now the corporation tax rate has settled down at the top rate at 25%. The super deduction has fallen away, and it's been replaced by full expensing. So this is allowing all of the plant and machinery allowances incurred and be deducted in the year that they've been incurred. So it's hopefully it's going to be fairly stable. I've not heard anything on the rumor mill that's going to be tinkered with, but I know that this government's agenda is for growth, for driving growth, and so there may be some further incentives to come. But from what I seen historically, they're trying to carve out the bit for property expenditure, which is seen as stable long term, and try and focus the incentives on non-property expenditure. So I'm hoping that those types of relief are going to remain stable. You mentioned capital allowance cases. The big case that's ongoing at the moment is the Orsted case. This is relating to incidental costs, typically professional fees relating to the installation of, in this case, it was wind farms, offshore wind farms, and it was in relation to how much of the design, development, and the intellectual preparation of a site, how much of those costs could be deemed to be in the provision of plants. So the part of the legislation is you can claim allowances or costs associated with the provision of plant and machinery, and it's trying to determine how broad that term can be interpreted. The historical case is a Benodica case, which disallowed financing costs. They were deemed to be too remote from the provision of plant. Whereas this more recent case it's around a lot of the studies that were undertaken in order to ensure that the wind turbines would have stayed upright. HMRC initially won, and then the Court of Appeal, the taxpayers won, and I understand it is going to go back to Supreme Court above the Court of Appeal to be reviewed again. So we thought we had a really good case because it was in the Court of Appeals, therefore it was binding on it was supportive of other taxpayers, but it's going to be challenged, so we'll have to wait and see what comes out of that. And then we've seen HMRC increase their scrutiny of second-hand acquisitions. So this is quite a regular occurrence now, where HMRC will just ask for a slightly additional burden of proof on determining where things may fall outside of Section 198. So HMRC's preferred method of transferring allowances is via the Section 198 election. Looking at anything outside of that, they're starting to seek additional reassurance that anything that falls outside of election there is actually an entitlement for those assets. And finally, as a sort of bit in passing, was that the valuation offers agency is going to be folded into HMRC. Historically, the VO had a specialist capital allowances team. I suspect a lot of those queries will be passed across to HMRC, but that's we have nothing further on that at the moment.
I guess the obvious question, and you might have just answered it, but if there is a change of the administrative mechanism at the revenue for consideration of the allowances, do you think that there'll be more inquiries into capital allowance claims, or do you think that it will just remain stable? It's just the people will be having a different employer.
No, it's been a long time since the valuation office would get their surveyors to go out and do their own surveying assessments. So this is something that used to happen. I wouldn't say regularly, but it was always a consideration that you could have a surveyor, qualified surveyor from the VO turn up at your site to undertake their own assessment of an apportionment. So where we're doing an apportionment of a second-hand building, you would have to do an estimated reconstruction cost. That's a surveyor's task. You would have to do a bare site land value assessment. Again, that's a surveyor's task. But those types of visits and assessments have fallen by the wayside for quite a number of years, and we haven't seen those type of inquiries for quite some time. So, but what we have seen an increase of is more on the tax technical side of things. So, do you have an entitlement? And that is more of a document trail, a paper trail, to see whether you have the right to claim the allowances in a certain area, and less around trying to determine what the value of those allowances are. So I suspect that within the capital allowances world, we'll see similar to what goes on in other areas of tax, most notably the R&D allowances, where there's a lot of pre-approval going on in that area. I can imagine we'll see that certainly on the entitlement side of things, which is a bit murkier as HMRC try and push everyone to a more standardized form of reporting.
So I think so far in this session, we've dealt with a lot of the technical about what's allowable and processes to make sure you get your allowance. I think we're moving into administration now. So, just sticking to that theme, what would be your message to businesses if they feel that there's a claim to be made, that just make sure that they don't risk coming under too much revenue scrutiny?
I would say the HMRC like a paper trail. They like to see some form of evidence to support the assumptions that are being made. Now, the form of that paper trail can be quite wide-ranging, but I don't think that we will go back to the days where on an apportionment you could say, well, we used to have to check back all prior owners back to 1996, and once upon a time you could get away with saying, well, I wrote to the former owner, I didn't get a response, and therefore I have no evidence that a claim has been made. And so you're looking for a double negative. That type of assertion, I think, won't be tolerated going forward. You will need some sort of positive confirmation back saying, no, we have not made a claim. So whether that's in the CPSE replies, whether it's in the heads of terms, whether it's in the contract, or even within some other type of communication. It may even just be direct communication with the vendor's tax advisor. Oh, no, there's been no additions to the capital allowances pools during our ownership, whatever it might be. But they will look for more of the confirmation that something hasn't happened, as opposed to the absence of confirmation that something has happened. It's less of an issue with construction projects, because they tend to be construction contracts, and so you'll have a contract which says we have spent this money, and then you can go and point at something that you've spent the money on. it's more that in the space around the acquisitions. And so stepping back, to avoid problems, it's a timing issue. So getting in early, getting things documented, getting things agreed, and then being able to, as part of going through that the either transaction or the construction project, is collating the relevant documents and keeping them together, and then providing those to a suitable advisor to be able to, for them to put a claim together, whether that's a tax advisor or a capital allowance specialist, is having that supportive evidence. And it doesn't necessarily all need to be submitted to HMRC in one go. In the past, HMRC have said, send us the summaries, and if we want the detail, we'll come back to you for the detail. But it's useful to have that project file which has all of that information in it.
I think the message there is that whilst claiming an allowance might be an annual thing in a tax comp, and maybe in some years you put more, you're able to claim more because you spent some more money, but actually a big takeaway is the history of the building and documenting in real time, what you've claimed, why you've claimed, and literally just putting it in a file. That may get dustier over years, but there will become a time in the future, maybe 10 years, maybe 15 years, that building gets sold or something happens to it, and you're really glad you kept that information in real time. So just we're coming towards the end, because it's 10 to coming up to 10 to 12, but just give us some real world examples of some work that you've done and how capital allowances made a difference.
Okay. Right. So I think I've got a. Okay, on an acquisition. So we looked at an acquisition. We had a client who had bought. They bought a series of business centres to be used as flexible offices, so like a Regis or a WeWork style setup. And all of the properties had come with a Section 198 selection. Just £1, nothing to see here. No allowance is going to be transferred. It was a reasonably distressed sale, and so the seller was not being cooperative beyond the sale. However, in the CPSEs, they had confirmed in writing that they hadn't made any claims for capital allowances. So we had an election which had a certain amount of restriction, but on the CPSEs, they said they hadn't claimed. Because these were business centres, they had a lot of loose equipment in them. So these are all the desks, the chairs, the cutlery, the crockery, the telephones, the projector stands, all those items. Because they're all loose chattels, they didn't fall within the scope of the Section 198 election, which only refers to fixtures. And so we were able to go in and assess the value of those items relative to the overall transaction in order to identify additional plant and machinery allowances that initially the client thought they weren't going to get. And this overall deal is about £25 million for these centres, and we found over £1 million worth of contents within these transactions, which was excellent. I mean, the client was obviously very surprised because he thought he was only going to get the few pounds worth of elections, and they ended up with over £1 million, and that's all main pool plant and machinery allowances as well. So it was able to get an accelerated relief on those. On the capex side of things, got an example springs to mind of where something didn't go quite right and we managed to rectify it. So this is a multi-year project where the project grew from an office refurbishment on one site into an office construction on the same site and a data center construction on a separate site. And the initial office refurbishment was undertaken. The review was undertaken in-house, and a certain amount of allowances were claimed on that. And then that percentage breakdown of the allowances claimed on office refurbishment would then just roll forward for years 2 and 3. And we got involved in year 4 and come across, looked at this, office refurbishments tend to have very high qualifying plant and machinery allowances. It's like, you've claimed super deduction on all of these, all of this expenditure, whereas you've actually been digging holes in the ground for a data center, digging holes in the ground for an office building. So we have to go in and undo some of that work and reanalyze it correctly to be able to claim proper allowances in all of those for tax years. And that goes back to the point that we talked about earlier about making sure that your expenditure is reconciled in each tax period. So the construction cost expenditure is reconciled in each tax year in order to make sure that you're not overstating or understating the allowances. So yeah, most of the stories that we talk about are trying to find additional allowances. In that case, it was almost about getting the allowances into the right pots to make sure that the client wasn't going to be subject to an inquiry from HMRC for overstating super deductions that they were no longer entitled to.
And funnily enough, on a similar vein, I can think of a high street retailer that I used to act for that really, I think they were trying to save on professional costs. And so they sort of stratified their stores as to call it a big store, a medium store, and a small store. And they just did a survey of one small store, one medium store, one large store. And then through their in-house tax team, tried to run an argument with revenue that, you know, if they had 5 big stores open up, well, they just did 5 times the sample. And you can sort of see where the logic comes from. But, you know, even me as a non-capital allowance specialist could walk around, you know, 2 of their big stores and see differences. And I think that's, you know, that's very similar to your data center in terms of, you know, in terms of the capital allowance professional costs, people like yourselves, it's well worth spending that money, because what you're doing is you are generating the additional value over and above the sort of the base costs that the client may just naturally assume themselves. And your £1 example on the WeWork type is just another situation.
Yeah.
Yeah. So
Yeah. Yeah, we like to think that yeah, we can not only find either additional value in that WeWork example, but we also provide the ability to sleep at night peacefully on the other example.
yeah, no. So, you know, what would you say to that business owner who knows there might be some spend out there that's qualifying, but is not entirely sure how much, and therefore, you know, the cost benefit analysis of getting some professional advice?
Well, most people most people will be probably claiming some sort of capital allowances anyway, just in the nature of their business on items which are features of the desks and things like that. It's where you get into the large property type expenditure where stuff just can just disappear not into the cracks, but it just gets lumped together and dropped in either non-qualifying or SBAs, and there's a timing benefit and a cash benefit to having that type of expenditure in the right pools. And so if you're unsure, it's always worth asking the question. Don't assume that somebody else has done this. Ask the question. In most cases, there's typically no charge for looking. So the first assessment to go and have a look and review and see what's happened, what's been done, who's done it. That there's typically no charge for that, because it's just working out whether something needs to be done or not. And so where we get involved, it's to make a difference. So where we review things, we sometimes review things and go, yeah, it's all fine, it's all been done, there's nothing extra to be done here, and fine, you can be on your way. But more often than not, there are additional angles that we can look at, or we can, because we have a surveying background, we can recreate construction costs from first principles. So if you have a lump sum and you're not sure what's in it, you know, we can see the building and see the amount of money that's been spent. We can put together a construction cost estimate, which can be used for HMRC with HMRC to claim the allowances, because we have that experience with our surveying hats on to be able to do that.
Brilliant. Thank you, Michael. As we are rapidly coming up to midday and, we wouldn't want to overrun, if I just asked you for one final takeaway, if there's one thing the audience remember from today, what would you suggest it should be?
Oh, out of one, it would be, probably don't assume someone else is doing it. Go and check. So it's I think it was two. Don't assume someone else is doing it. Talk about it early. So they're the two things. It'd be, don't assume someone else is doing it. Ask questions early.
Brilliant. And I think that fits in nicely to my question, or the question that came through about the four professionals. There's a classic example where everyone's pointing at someone else,
Yeah,
thinking we suspect you're leading it. And actually that question was quite a powerful question, as to someone's got to manage a process, and you
yeah,
determined in your own who that should be. So look, Michael Brownston, thank you very much. MJS Tax Capital Allowance Specialist, and as I said, they've got a little stamp duty
yeah.
arm as well. As we've got 1 minute, can I give you just the opportunity to give 30 seconds say of what your stamp duty team do, because it is relevant to property
Certainly,
purchases.
certainly, yeah. It's a similar sort of premise when you're buying a property is segregating out the costs for different purposes. Land and building are subject to stamp duty, contents are not. And so we review purchases to segregate out contents and strip that out of the stamp duty calculations. We do it on an apportionment basis. That's what the legislation requires. But it's all saved off the top line. So if you're paying a stamp at 10, 12, or 15% or higher, then all your savings are at that level.
Brilliant. Thank you, Michael. Thank you, audience. As I said at the head of the show, it's been recorded. We can send you a link, and obviously, if you want to pass it amongst your colleagues who may be relevant for them, then that's absolutely fine. Michael's contact details will be included. And thank you very much, and have a good morning.